Well, we've talked a bit, and I'm sure you've thought a lot about assets that are particularly conducive for charitable giving, those things that work well. And now we're going to talk about the things that maybe don't work so well. So under the theme of, America's Most Wanted, these would be sort of American charities least wanted. And there are 10. There are more than 10, but these are 10 that would kind of literally keep me up at night if I were a charity and receiving these kinds of assets. And frankly, if I were an advisor working with a donor or a client that was trying to give these kinds of assets. So these come up a fair amount, so I want to maybe go through these one at a time. So first one, timeshares. There's just nothing good about timeshares. I can maybe just stop there. There has never been a timeshare that I have ever heard about or read about that has increased in value over time. Never going to get a capital gain out of a timeshare. So many advisors, and I think donors too, think, well, we can't sell the timeshares, so instead we're just going to give these timeshares to the charity. I don't want to use the word dump on charity, but let's say give to charity, and they, I'm sure, know what to do with it. No charities know what to do with timeshares. So even if the charity receives them, we don't have a magic wand that we can poof them into cash, and the difficulty that the donor would have selling that timeshare, charities would too. Most importantly, because there's no appreciation, it's better for the donor to sell it him or herself anyway because there's not any gain. And if a charity tries to sell it, this is somewhat of a joke, but not, the charity's going to spend probably 20 hours a week for the next 4 months. And at the end of that process, we'll get about $340 as the net proceeds from that timeshare. So these are not good assets to consider giving to charities, and charities should be very reluctant to taking them. Second, briefly, and you'll understand why, but negative basis pre-1986 tax shelter partnerships. The old burned out partnerships. I still get this question about once a month. It used to be about once a week 10 years ago, so they are eventually weaning off here. But any pre-86 tax shelter with negative basis, or any partnership, frankly, with maybe less than $10,000, $15,000, $20,000, very difficult for charities to do the assessment, receive the gift, without some clear path to fairly quick liquidity. So in particular, these pre-86 tax shelter partnerships are not good. Third, things that eat. For a charity to receive a gift of an animal that eats things, that means they have to be put somewhere and vet bills and all these kinds of things. Unless it can be sold quite quickly, any kind of upkeep on any animals is usually not a good idea. Now, having said that, we actually did a $400,000 quarter horse that we owned for about a week as a charity. So it can work, and there are some very interesting tax advantages to actually giving inventory. So if you're a farmer and you've got cattle, and that cattle would otherwise be deemed to be long-term capital gain, there are actually a number of situations where the cattle itself could be donated to the charity prior to auction. But the general rules are things that eat, that you don't have a real clear sales path, are usually not going to end very well at all, and will eat and expenses and other kinds of things. Number 4, any kind of vehicle. So vehicles are usually not good. So cars, boats, planes. We worked on a number of planes, I think one boat in the past. There are always exceptions, but cars, boats, and planes fall under the vehicle rules, very much tightened in 2004 by the IRS, that basically say the fair market value of the actual gift is going to be whatever the net proceeds, net sales proceeds would be at the time of sale. So the car that's worth $20,000 on Kelley Blue Book, let's make up, but sells for $1,000 and the charity gets $400, the IRS would say the value is $400. But here's where it gets tricky. That's the value. The cars, boats, and planes as the vehicles are still tangible personal property. So unless the charity is putting that to a related use, the deduction is actually the lesser of whatever that net sales proceeds value is, or the cost basis of the vehicle itself. In most situations, nearly all, the cost basis is much higher. You pay more for these kinds of vehicles because they are naturally degrading in value over time, which gets back kind of to the timeshare, just better for the donor to sell it his or herself and give the charity cash. Number 5, life insurance with loans. If a life insurance policy has a loan, technically speaking, there should be no deduction at all. So be very, very careful about life insurance policies being donated to charity with loans. They also can create unrelated business taxable income to the charity under the debt-financed income rules. So very complicated. It's important to clean those loans up prior to making that gift to charity. Number 6, patent or copyrights without revenue. I get this call a lot as well. I've got this great idea. I've got a patent. I've written this book. I've got the copyright. But there is no revenue behind that. The patent perhaps is not licensed. No royalties are coming in from the copyrights. Very, very difficult to sell those kinds of assets. And those fall under a completely other subset of the Internal Revenue Code around intangible personal property. So other complex rules there, but if there's no revenue coming in, pretty consistent and pretty big, from this patent and copyrights, generally not a good idea to give. Somewhat on that note, and I don't even mention it here, but oil and gas partnerships would be similar. So a lot of times I'll see a charity, they'll receive an estate gift of a 0.0002% interest in a Permian Basin, Texas oil find. In many cases, they've been split over time, and they might be getting, I'm making this up, $16 a year as royalty or lease income. So unless there's some real value there, the time and effort that it would take to actually convert that to cash and for the charitable purpose, somebody told me once, the juice isn't worth the squeeze. So I want to be a little bit careful about the benefit cost analysis of those kinds of gifts too. Which go right to number 7. I've got small undeveloped lots on the moon or the earth. So I actually had a person call me about a moon deed one time, so I included that. But a lot of times you'll have donors or clients that will say, well, we bought these lots in Arizona and it was supposed to be an incredible development and equestrian center and the whole 9 yards, but it never sort of happened. Or we thought we were going to move somewhere, but we really never did. So for lots that are less than usually $30,000, $40,000, $50,000 or so, it all goes to marketability. Can you actually get that converted to cash within a reasonable period of time? And what is the holding cost and maintenance and staff time that would have to be devoted for carrying that specific asset? So very important, again, on the assessment side for the charity, but as an advisor for you to understand it may not be a real gift that the charity would be able to use at any point in time. Number 8, burial plots. So my joke is anytime you get a burial plot, you will never get rid of that from the charity's books. Same thing, kind of like undeveloped lots. These are undeveloped lots in the cemetery, but it's where donors might have purchased those or they've been left those lots by parents. And the resale market for those is also quite difficult. Almost never is there an appreciation or gain. So yet another area where the donor could sell that lot, hopefully first, and then give the proceeds over to the charity. Installment notes and annuities is number 9. So these are a little bit tricky in that any gifts donated to a charity of, let's say, an installment note, where they've been taking capital gains tax treatment over time for the sale of a business or the sale of a piece of real estate, let's say. If they were to give that note to the charity, most all donors think that the capital gain then is eliminated for any of the future payments, and that's actually not the case. That gain is accelerated as soon as that note is given back to the donor, and annuities are the same way. So if you have an annuity and you paid $100,000 for it and now it's worth $200,000, many donors think, well, I'll just give that annuity during life to the charity and I'll be able to take a $200,000 deduction and have no gain. And in fact, it's doubly wrong. First, the deduction, because it's ordinary income, is the lesser of the 200 and 100. So it'd be the 100,000 would be the deduction, but the other $100,000 is immediately recognized on transfer to the charity. So the 100,000 of ordinary income is immediately recognized to the donor in that case. So be very careful, installment notes and annuities. And non-qualified stock options, exactly the same theme. They're starting to come back now. Heard a lot about those in the 90s and kind of went away for a bit, but now coming back. And if a donor has or a client has non-qualified stock options and they'd say, well, I can exercise that option at $10. It's currently in the money trading for $20. I will just transfer those options over to the charity and not have to recognize any of that income. And that does not work in that situation. As soon as that stock option is transferred, it's going to trigger that gain in that option from the strike price up to the current price. So those are 10, there are more, 10 assets that are the least wanted, certainly by charities, but also from a tax perspective and management perspective. The theme here is in many cases the charities would love to have the net proceeds of all of these things, but having the donor or your client sell those assets first and then transfer those assets, or even better, other long-term capital gain assets instead over to the charity is much more tax optimal.